Morningstar published a headline in February 2026 that made every retirement account holder check their balance twice. Your S&P 500 index fund might be riskier than the internet bubble. The data behind it was simple. 7 tech companies now make up over 33% of the entire index. The Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Tesla, Meta, Alphabet. Everyone else, the other 493 companies, they've never mattered less. And the last time market concentration hit this level was March 2000, right before the NASDAQ dropped 78%. So naturally, every financial advisor with a podcast started screaming about portfolio rebalancing. Every newsletter turned into a crash prediction factory. And retirees, people who spent 30 years building their nest egg, they started losing sleep. Here's what nobody's telling you though. The 2000 crash didn't destroy retirement accounts. What destroyed them was what people did at 2001, 2002, 2003. I'm going to show you why the crash everyone's predicting for 2026 probably won't happen the way they think. But even if it does, there's a single psychological trap that turns temporary losses into permanent damage. And once you see how this trap works, you'll stop checking your portfolio every morning like it's a pregnancy test. We're going to walk through the actual data on market concentration, the math on what happens when you bail out during fear, and the 3 specific things smart retirees do differently that lets them sleep through volatility that makes everyone else panic sell. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Here's the model I want you to understand first. Think of retirement investing like a fire drill. Everyone practices the same drill. Market drops, you rebalance. Volatility spikes, you go defensive. Headlines scream, crash, you trim risk. The problem is, you're drilling for the wrong emergency. The real fire isn't the market dropping 20%. The real fire is you, standing there with a full tank of capital, watching prices fall, and doing the one thing that guarantees you lock-in losses forever: selling. And then not buying back in until the recovery's already happened. That's the house fire nobody practices for. Your own panic. Look at what actually happened during the concentration peaks everyone's using to predict 2026. Over the last 100 years, the market has hit extreme concentration 7 different times. Everyone points to March 2000 like it's the only data point that matters. Here's what they don't mention. 5 out of those 7 times, the market didn't crash. It went up. After the 2008 crisis, concentration spiked. Market went up the next year. After COVID in 2020, same thing. Concentration hit record levels. Everyone predicted disaster, and the S&P climbed another 26% in 2021. So using concentration as a sell signal is like selling your house every time you smell smoke from a neighbor's barbecue. You're reacting to the wrong trigger. But here's where it gets interesting. Even in the years where the market did go up after high concentration, most retiree portfolios didn't. Morgan Stanley tracked this during 2008. They followed real behavior. When people pulled money out, when they put it back in. The market, if you just held a 60-40 stock to bond portfolio, it dropped hard in 2008, then fully recovered by 2010, round trip. You ended where you started, plus gains. But the average investor, the real human making real decisions, they sold during peak fear. Not at the bottom, they're not that good at timing. They sold on the way down, somewhere around the 70% mark. Then they waited, and only put money back in after the recovery was already underway. By 2010, they were down over 20% compared to the person who just sat there and did nothing. Same market, same time period, completely different outcome. The market didn't ruin them. Their fire drill did. There's a guy I knew who ran a small manufacturing business through the 90s. He wasn't sophisticated, didn't read financial news. He had a 401k through his company, some Vanguard target date fund, and he genuinely forgot the login password for like 3 years. 2008 happens, his friends are all panic selling, moving to cash, and he's asking me how to reset his password because he wants to see the damage. I told him, don't look. Just don't look. He thought I was joking, but 6 months later, he still hadn't logged in. By 2010, he checks, and he's actually up from where he was in 2007. Not because he was smart, because he was lazy. And lazy beat active. His friends who sold, they were still trying to figure out when to get back in while he was already recovering. Lazy investing built more fortune than crypto memes. Now you're asking yourself, okay, but what if 2026 really is different? What if this is the big one? Fair question. Let me show you what actually happens when you try to dodge the crash by moving to cash. Vanguard ran the numbers on every time the market dropped at least 5%. They tracked what happened if you bailed out and sat in cash. If you stayed out for 3 months, you underperformed 61% of the time. 6 months, 72%. A full year, which is what most people did in 2008, you underperformed 79% of the time. The median gap was 9%. So you're not just missing the recovery, you're mathematically stacking the deck against yourself. This is the fire drill problem again. You practice evacuating, but you never practice getting back inside while the house is still warm. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Here's the part that'll make you rethink everything. This chart, and I'm looking at data going back to 1976, shows the 20 worst single trading days in market history. The days where you wake up, check your phone, and your account is down 6 figures before breakfast. 9 of those 20 days happened in years where the market finished positive. Not just recovered, finished up for the year. So the worst day of trading, the one that feels like the start of the apocalypse, it's often just noise inside a positive year. The days that feel like you should sell are exactly the days you need to hold. Smart retirees understand this. They've trained themselves to see volatility as the entry price for long-term returns, not a warning signal. There's a parable in poker that applies here. Bad players, they think the goal is to avoid losses, so they fold any hand that feels risky. They protect their stack. Good players know the goal is to maximize expected value over hundreds of hands. That means sometimes you take a calculated loss because the math works over time. Retirees who bail during volatility, they're playing like bad poker players. They're optimizing for short-term comfort instead of long-term wealth. And the math punishes that every single time. Let me give you a concrete case study with real numbers. 2 guys, both 55 years old in 2007. Both have exactly $1 million in their retirement accounts. Both in a standard S&P 500 index fund. Guy A, let's call him Panic Paul. He reads the news. He's informed. He sees the housing crisis coming. Sells in October 2008 when the market's down 30%. Moves to cash. He just saved himself from further losses, right? Smart move. He sits in cash, waits for the bottom, but he can't time it perfectly. Nobody can. He gets back in around March 2010 when the market's already recovered 25% from the lows. Guy B, let's call him Lazy Larry, he doesn't even know there's a crisis. He's busy with work, doesn't check his account, just keeps auto-investing his monthly contributions like nothing happened. By 2015, Panic Paul has about $1,200,000. Not bad. He protected some capital, got back in, rode the recovery. Lazy Larry has $1,600,000. $400,000 difference. Same starting point, same market, same time period. Paul's fire drill cost him a beach house. Now think about the psychology here for a second. Paul felt smart in 2008. He dodged pain. He slept better. His friends called him prudent. Larry looked stupid. His account was down 40% and he didn't even flinch. But 7 years later, Larry's buying a second property and Paul's still working. The fire drill trains you for the wrong outcome. It trains you to avoid the feeling of loss, not the reality of loss. And those are completely different things. Here's the shift that changes everything. Warren Buffett has this line everyone quotes, but nobody actually internalizes. Be fearful when others are greedy, and greedy when others are fearful. Sounds good on a coffee mug. But look at what he actually did during the 2000 crash. Everyone was piling into tech stocks in 1999, dot-com fever, companies with no revenue trading at billion-dollar valuations. Buffett bought boring stuff, insurance companies, railroads, utilities, things that made money. His portfolio got crushed by comparison during the run-up. People called him washed up, out of touch. Then 2000 hits. The NASDAQ falls 78%. All those hot tech stocks, gone. And Buffett's boring companies, they just kept chugging along, paying dividends, generating cash. By 2005, he's outperformed every tech fund on the planet. Not because he predicted the crash, because he built a portfolio that didn't need the party to continue. This is what smart retirees do. They don't try to time the crash. They build a portfolio that survives it by default. There's another layer here that nobody talks about. The best days and worst days in the market are clustered together. Vanguard found that if you missed the 10 best days over a 30-year period, your returns dropped by over half, 50%. And here's the kicker. 7 of those 10 best days happened within 2 weeks of the 10 worst days. So when you bail out to avoid the pain, you also miss the recovery snapback that makes the whole thing worth it. You can't separate the good volatility from the bad volatility. They come as a package. The fire drill never taught you that. Comedic cutaway. Imagine calling your financial advisor in 2008. Hey, the market's down 40%. What should I do? And he says, nothing. Absolutely nothing. In fact, invest more. You think he's insane. You'd probably fire him. But that's literally the correct answer. The psychological gap between correct advice and advice that feels correct, that's where fortunes get lost. Let me show you one more thing that'll make this clear. This timeline goes back 30 years, 1994 to 2024. During that period, you lived through the tech bubble crash, September 11th, the 2008 financial crisis, the European debt crisis, COVID, multiple wars, political chaos, everything. If I told you in 1994 that all of that was coming, you'd never invest $1. You'd buy gold and canned food. But someone who put $1 million into the market in 1994 and just held, ignoring every headline, every crash, every reason to panic, they'd have about $6 million today. The further you zoom out, the clearer it gets. There are always reasons to sell. The market doesn't care. It just keeps compounding. Now, the 3 things you actually need to do differently. First, stop checking your account during volatility. I'm serious. The data on this is clear. The more often you check your portfolio during a downturn, the more likely you are to make an emotional decision. There's a concept in behavioral economics called myopic loss aversion. The more frequently you evaluate your losses, the more painful they feel, and the more likely you are to do something stupid to stop the pain. Benarty and Thaler did the research on this. Investors who checked their accounts annually had higher returns than investors who checked monthly. Not because the market was different, because their behavior was different. So during the next crash, and there will be a next crash, delete the app, forget the password. Train yourself to measure success in decades, not days. Second, build a portfolio that's boring enough to hold during panic. I've got multiple hundreds of thousands of dollars invested, and my portfolio would make a 25-year-old Redditor fall asleep. Index funds, dividend aristocrats, boring stuff that generates cash regardless of what the market does. I don't need Tesla to triple for my retirement to work. I need Johnson & Johnson to keep selling Band-Aids. When you build a portfolio that depends on hype continuing, you're setting yourself up for the fire drill failure. You'll bail the second the narrative cracks. But when you own boring, cash-flowing businesses, you can hold through anything because the underlying engine doesn't stop. Buffett figured this out 40 years ago. Most retirees still haven't. Third, and this is the one nobody wants to hear, you need to pre-commit to doing nothing. Literally write down your plan for the next crash. When the market drops 20%, I will do nothing. When it drops 30%, I will invest more. When headlines say it's different this time, I will reread this note and do nothing. Ulysses had himself tied to the mast so he couldn't steer the ship toward the sirens. You need the investing equivalent, a pre-commitment device that stops you from panic selling when your brain is flooded with cortisol and your neighbor is telling you he moved everything to cash. The crash doesn't kill you. Your untrained reaction to the crash kills you. Comedic cutaway. Financial media in 2008. The market's down 40%. Here's 5 experts to tell you what to do next. Financial media in 2009. The market's up 60%. Here's 5 experts to explain why they saw it coming. Same experts, different year, none of them helpful. So here's what actually happens in 2026. Maybe the market crashes, maybe it doesn't. Concentration is high, sure. But it's been high before, and the outcome wasn't predictable. What is predictable is this. When volatility comes, and it always comes, most people will do the fire drill they've been trained for. They'll sell to stop the pain. They'll wait for certainty before getting back in, and they'll lock in losses that take years to recover from. The retirees who understand this, the ones who've built boring portfolios, who've pre-committed to inaction, who've trained themselves to zoom out instead of panicking, they'll be fine. Not because they're smarter, because they practice for the right emergency. The market is predictable over decades. Your behavior during crashes is what's random. Fix the behavior and the market takes care of itself. And if you still feel like you need to do something during the next crash, go ahead and check that early retirement calculator I built. At least you'll be stressing about math instead of emotions.